What is up, everyone? We're going with a little bit of a different type of video as we fear there's the potential here for another red day. I just see, just based off futures, it looks like today might be a little bit of a red day. So we're going to have a little special video again because there's some deals in the market happening right now. So we're going to make another stocks to buy video, but this one is going to be specifically stocks that I'm focused on the dividend for, okay? Now, some of these will have the ability for capital appreciation after the recent downturn we've had in the market, and others I really just care about mostly to hold on for dividends. So we're going to go ahead and right into it. I've got 4 for you today, so I really hope you enjoy. Let's get right into these dividend stocks that I think are worth buying right now. So first off, as you see on your screen, is New Residential Investment Corp, ticker symbol NRZ. So you see some price issues we've had. Just look over the last month here. Really, since the downturn started, we've seen an 11.5% decrease in share value. Where if you look over a 1-year period, really this thing typically is floating around the 16.5 mark. Recently got up to in the 17s, but historically we float somewhere around the 16 for this, and the reason for that is because this is a very high yielding stock. So this stock yields quite high, typically upwards of 10%, and that's why you don't see much change in terms of share appreciation. So typically the value of these shares does not fluctuate too heavily, just due to the fact that most of the gains you get on the stock are going to be through dividends. So what is New Residential Investment Corporation? Well, it's an interesting one to explain. So as opposed to companies that own real estate, I think it's good to compare them to them. So obviously your companies that own real estate they own physical properties. Now what New Residential Investment does is they actually own the loans that people take on those properties. So they are investing in loans, and pretty much with those loans they get paid back, obviously through interest and just through the loans themselves when they get paid off. So they invest in loans. And I have to say, this is a business model that certainly is a potential risk, and I don't think there's any denying it because it's an inconsistent business model. It's not something that's steady, that they're always going to be able to find success in. And for that reason, it's one that I don't really think I care about for share value. It's more for dividend yield. So one thing you will notice with New Residential Investment is that this dividend yield is not going to be a consistent one. So it's not going to be inconsistent because of share value. It's going to be inconsistent because of what they can pay out. That is, again, the issue with the nature of their business. There are going to be some times in which the housing market's not doing as well, where there's not as many loans going out there, where they really won't be able to find as much revenue. They really won't. And for that, they might decrease the dividend they're paying out. So this is a company that you can expect to see dividend increases, decreases pretty regularly. So that is something to note with New Residential, but they actually have a current market cap of $6.7 billion. Right now yielding 12.4%. Right now they have paid approximately total of 3.3 billion dividends. That's right. Right now in assets they have around 44.9 billion. So that's going to include their investments for sure. They have a very diversified portfolio, which we will get into pretty shortly. So they have a hard to replace portfolio as well. They have an opportunistic growth strategy. So this is a company that's not really just focused on staying consistent, but they are looking on what they can do to improve in the future. They've got a proven track record, as we can see for sure in the history of this company. They're focused on capturing the full value of a mortgage asset. So when they're buying these loans off people, they're really trying to get the full value off of that. They're not trying to get skipped out on any of that value. They want all of it. And they have a good focus on the shareholder, which you see in the return and the value of dividends. So this company right now, pretty well fair in terms of value, trading at a forward PE of 7.0 7.4, which is obviously very, very cheap. And if you look historically, it typically is around the 7 range anyways. So there's nothing too crazy. But I do like the price to book on this company, right around 1, which again is historically around where it trades as well. So this is a stock that even at the current value, I don't think is one that is overvalued by any means. It's a little bit different. It's harder to necessarily track the value of these type of companies. These real estate investment trust or investment type companies like this, it's really hard to track it based off standard valuation metrics like this. But overall, I do think the company is relatively fairly valued. And if we look historically as far as revenue is concerned, you can see a bit of this fluctuation in the market for sure. For them, overall, looks like they are currently doing around $1 billion in revenue. Around 1.27 right now in revenue. So that's just for the full year, trailing 12 month. You see the year prior to that was 1.35 million, and the year prior was 1.4. Then the year before that was only 780 million versus the 1.4 billion number that they put the next year up. So again, it fluctuates. It really does fluctuate. And you see from a net income perspective, this will fluctuate as well. It really just depends on market conditions. So that is one thing to consider with this company. Overall, you see a current yield actually around 12.8 with a payout ratio, again, a little bit under 100, but 92.28. And the thing about this, obviously, you see that's a high payout ratio, anything around 100. But these type of companies typically will get they get tax breaks if they are paying out over 90% of their assets or profit really in dividends, in the form of dividends. They get tax breaks for it. So that's why they typically will do this. Currently, it's 50 cents per share. As far as this is concerned, they do pay quarterly as well. And as I mentioned, no dividend growth history. If you look here, since 2013, there's not that much growth going on here. 3-year annualized growth rate of 2.82. You can't really expect too much out of this company from the history of the dividend. Pretty well consistently. It was sitting at 46 for a while, then bumped up to 50, and it's been at 50 for a solid 2-3 years at this point. Nearly 3, probably 2.5, so nothing crazy going on here. So it's something I do like. I am a big fan of this company. Because of that, if we look at a couple of their highlights here, so their mission is to generate attractive risk-adjusted returns across all interest rate environments through our portfolio investments. Fun stuff for sure. They're quick facts on the bottom. You see out of their portfolio on your bottom here, you see majority of it right now is made of SMR or MSRs and server advances. After that, 28% is made up of residential securities and call rights. Then residential loans makes up around 18%. Organizational makes up 5%, and servicing around 3%, then 1% in other. So in the year 2019, they returned 27% to shareholders. Exciting stuff. Again, the market went up pretty much around then anyways, but that's still some exciting stuff if you account for a yield plus the gain you get from this too. It's interesting stuff. And as we talk about a very volatile market environment, I like dividend stocks because when the market's going down, your dividend will still pay out to you. So that's pretty exciting stuff. So they made some acquisitions of some assets from Ditech, Covius, and Guardian Asset Management, as you see here. They have 21 securitizations. Always good stuff. So that's really it for new residential. We'll get on to the next one now. So that is the start. Next one will be Apple Hospitality. Not the Apple you might know and love, but this is a different Apple, and I like it quite a bit. I am a huge fan of Apple. Both Apples, to be fair. So if we're looking a month out, you see since the downturn here, this thing's faced around a 13.5% decrease in share value. If we look 5 years out, this is again one that hovers right around the $17 range. Before this little meltdown we've had, it has been down around 11% over a around 5-year period. So it's been hovering around the 16 to 15 range this past year, and that's when I've picked it up, and I'm looking to pick up some more as it's down in the 13 range now, which obviously can draw some concern. There's no doubt regarding it, but let's look into this. What is Apple Hospitality? Well, Apple Hospitality, as in their words, is a publicly traded real estate investment trust that owns one of the largest and most diverse portfolios of upscale, rooms-focused hotels in the United States. Apple Hospitality's portfolio consists of 231 hotels, more than 29,500 guest rooms located in 87 markets throughout 34 states. They're concentrated with industry-level brands, with the company's portfolio consisting of 104 Marriott-branded hotels, 124 Hilton-branded, and 1 Hyatt-branded, and 2 independent hotels. So again, if you are talking about hotels, Marriott, Hilton, Hyatt, these are high-quality hotels. There's no doubt about it. These are certainly the top-tier hotels. These are the kind of hotels where typically or business people going on trips, sports teams traveling to an away team's stadium, they're going to be staying at one of these places. They're going to be staying at a Hilton or a Marriott location typically. That's just typically how it is. These are high quality hotels, and that's what I really like about them. These are brands that I'm a huge fan of just because sustainability wise, these are brands of hotels that will stay around for a while because there's always going to be a need for these high quality hotels. There's no doubt about it. We could take a look at this little investment map of where they have hotels. So again, I like their portfolio in terms of where they have these hotels located. Obviously, this isn't all of them, but these are just the ones that they actually own the rights to right now. If we talk about really people having expendable income, I think obviously, as you've noticed, wages have risen quite a bit in the last 4 or 5 years. One thing that happens with that is more expendable income, and with that, typically people can splurge, potentially go into higher class hotels than they typically would before. And with this, you might see more people coming into a Marriott or a Hilton hotel, which in turn, obviously, just good for them, but definitely good for Apple as well. So that is what we like to see with Apple Hospitality for sure. That's why I'm a huge fan of them. Let's look at some of the numbers here as we like to see. You see this portfolio map here. 34 states, 84 markets. Very fun stuff. So Apple right now trading at a trailing PE of around 17, which historically is a little bit cheap for them. No doubt about it. Price to book under 1, which is still relatively cheap for them historically. Price to sales, still cheap for them historically as well, around 2.33, which I like. So these are very fair value for this company, in my opinion. I think it's at a very cheap point. But again, with these real estate investment trusts, it's hard to necessarily get a grip on it. If you look revenue-wise, they have been relatively stagnant, but there has been some growth over the last 5 years in terms of revenue, last 4 years actually. So you see some growth from in 2016 of $1 billion in terms of revenue to over the last year, 2019, they put up $1.26 billion. So you do see about a 25% gain in terms of revenue over a 3-year period. It's not too bad. So that's some of the numbers there. As you see, net income pretty consistent here in terms of profit, which we like to see. Apple, as far as a dividend yield is concerned, right around 9% right now after the recent dip. Payout ratio is low right now too, but overall, what I like about this company is it's a 10-cent yield. You notice no dividend growth up here, but they pay monthly. So you get 10 cents every month with this company, and that's been consistently just what they've done. So since 2015, that's since the history they've been paying dividends, it's been 10 cents the entire time, which is awesome stuff because at that point, you're not scared of really a decrease here, and I'm not too scared because this payout ratio is not absurd for this company. They have the money to pay out 10 cents a month for sure. I think it's a pretty interesting stock for that reason. I like monthly income. There's another monthly income payer. I did not put it on this list, but this is one of the monthly income earners that I personally own right now, and I love it because every month I get the same consistent amount of money, which I could use towards really whatever I want. Typically it's been buying back, but if I wanted to one day take that money back and give myself a meal, I could certainly do that too. But overall, I really like Apple stock because of that. We're going to move on now out of these real estate investment trust type companies and into some more companies you might know a little bit better. We have Kohl's. I like this stock for many reasons. So if we look, obviously since downturn, this has seen a 12% decrease. Nothing shocking there, but really just over the past year, the thing's down around 40% from its highs. Where you see in 2018, this thing got up pretty high in the over 80 range, which is pretty exciting. Which historically it has been trading around the $40 range, which where it's right about right now. So what we'd like to see with Kohl's, let's take a look at what the company is. Obviously, one of the bigger clothing department stores you'll see out there, no doubt about it. So obviously, Kohl's has some fun stuff. So in 2015, obviously they started the pickup in store, buy online, pickup in store. 2004, they started Kohl's Cash, which is really one of the big things for them. Obviously, earning money back for money you spend in store, spending Kohl's Cash. It's every woman's dream, no doubt about it. Ladies love their Kohl's Cash. Their purpose, obviously, to inspire and empower families to lead fulfilling lives. Okay, it's clothing, guys. Let's not be crazy. Pillars, they focus on amazing product, easy experience, personalized connections, incredible savings, and they like winning teams. And Kohl's, I will say, they do certainly win this on savings. I think overall they're pretty cheap in terms of clothing. You typically see, I think they have a good price on clothing. Typically, Kohl's is not a bad place to be. You see their national footprint. So most of their stores are in strip centers, around 67%. 26% are freestanding. The one around me is freestanding, which is, it's rare to see. Normally they're going to be in a strip mall type environment, or just any sort of strip where they have stores right next door to them, where it's not disconnected. So by ownership, they have 44% leased, 36% owned, which is actually a relatively decently high percentage of owned. Typically a lot of these companies are leased. A majority of retail companies lease almost all of their properties just because, it's cheaper for them, it's better for them. So obviously by state, there's a breakdown here in terms of how many stores are in each state. Gotta love that. Obviously, we love talking about their amazing products. Brands like Nike, Under Armour, Adidas, Columbia, Fitbit, Tech Gear, Skechers, Converse, New Balance. That's right, talking about the active ones. Love it. For women's, we have Croft and Barrow. They got all this good stuff. For home care, they do in fact have more than just clothing. There's no doubt. They are closer, obviously, with that department brand type. They have shoes. They have your home care stuff like Cuddle Duds, Instapots, Food Network type stuff, KitchenAid products. So they have some appliances as well. No doubt about it. It's pretty cool. They've got women's, men's, children's. Seems offensive that's, they only mention women's and men's, but just kidding. Woo! They're focused on an easy experience, but that's why we like Kohl's. There's a lot you can go here. If you look at their investor relations page, just a lot going on there for Kohl's. I'll tell you what I like in just a little bit. So Let's take a look at these numbers. Trailing P of 9 and forward P of 8.5. So what I really like about this company, obviously, is valuation. It is something you're going to see with every single retail stock right now. Just frankly honest, a vast majority of retail stocks are going to be trading at this valuation. They're all getting hammered, and it's really just because Wall Street believes this is the value that they are worth. I think it's quite absurd. Wall Street believes that physical retail is dying, but I have quite an argument against it. I think in some aspect there is going to be some decrease in physical retail sales. There's no doubt about it. Traffic can decrease, and I think we're talking 5 years out. Overall, though, I like Kohl's because it's a company where I don't think there is an online replacement for it, at least a consistent one. If we're talking about clothing, and let's be 100% fair, there's a good reason why there are fitting rooms in clothing stores. If there's not, there's an issue. Clothing is not something you can really buy online because it's a hassle if you get it and it doesn't fit. It's a big hassle. And everyone knows that a medium in one brand is not the same as a medium in the other brand. It really just isn't. It really just depends. Medium can be anything. Really size, you need to actually wear it physically in the store before you know. Now, it could be one thing if you're not buying it in store and maybe you're buying it online, but still, Kohl's has a good online retail aspect too that really works for them. Clothing just isn't something you buy online. Let's just be 100% honest. I know some people might, but for the most part, most people really don't. But again, let's look at these valuation metrics just then, and then we'll look at some of the other aspects of this. So we see a price to sales of 0.31. Holy crap! Price to book of 1.14. This is very, very, very good. Very, very good value for this company right now in terms of what you're getting. And you see that with a lot of retailers right now. But I like this one specifically for the dividend too, just saying. If we're looking at the income statement here, historically, the revenue growth has been relatively stagnant, but nothing too crazy. I mean, $1.5 billion growth in 2 years is pretty exciting stuff still for a dying field. Where you see gross profit increasing as well, and a net income line pretty consistent as well, which you like to see. So overall, numbers are good for Kohl's. If we look at the dividend here, 6.85% forward yield, payout ratio of only 56, not bad. So they have room to grow. Dividend growth of 8 years in a row, and a 5-year annualized growth rate of 11.43. That's fantastic. Right now paying 67 cents a share, and they pay quarterly. I love to see it. It's a very good aspect. You like seeing that with the dividend. You love seeing a dividend growth rate chart like this. It's consistent growth. It's really consistent growth. One other aspect of why I like Kohl's is going to be that they actually do have a partnership with Amazon too. So we talk about online retail taking out these little babies. Well, guess what? These little babies, they're fighting back. Not necessarily, but they signed a deal with Amazon where they actually process Amazon returns in store now. So obviously you're like, what does that have to do with Kohl's? Well, for the most part, their goal is to drive traffic. That's really what it is. With clothing stores, you want people in their store because people get lost in looking at clothing. They really do. A lot of people do. I don't personally, because I have an agenda when I go into a clothing store. I want something specific. I definitely have never bought extra of really in any store in my life, but with a company like Kohl's, people, they get interested. They see this section of clothing, they're interested, and they're going to keep going, keep looking at stuff. So that's their goal, is to drive traffic. So it's pretty exciting stuff for them, offering returns from Amazon programs. So that's really why I like Kohl's. Last stock, it's going to be a controversial one, kind of. It's going to be Ford stock. Controversial because I think a lot of people are kind of on the negative. There's negative sentiment about Ford. There's no doubt, and you really see that in the value of it. Obviously, we look 1 month out. This stock is down a solid 22%. So this downturn hasn't been absurd for them. Really, around 12% growth, as you've seen with everyone else. If we're looking a year out, though, just this past month has been bad. Ever since a most recent earnings, they've been hit pretty darn hard. So they're at 52-week lows right now at this point. If you don't know Ford, obviously we have it's a car manufacturer. Everyone knows Ford's vehicles. Just here's a quick little list of their vehicles. Obviously fun stuff. And here's another little chart. So for their Ford F-Series, it's the #1 full-size pickup globally. The Ford Ranger is the #2 medium-sized pickup globally. The Transit is the #1 cargo van globally. The Explorer is #1, America's all-time best-selling SUV. That's right, the Ford Explorer. The Mustang is the #1 sports coupe globally. And the Bronco, it's a reintroduction. They're bringing back the old nameplate for the Bronco. So as far as what the future holds for them, they plan on creating, as you see down here, what they're offering. These are hybrid and electric offerings. On the right-hand side here, you see an electric Ford F-150 coming. The newest product, the Mustang Mach-E, which has had some good hype about it, and pre-sale numbers are looking good for the Mach-E, coming out in 2021. It's pretty exciting to see that. They also expect another Bronco coming out, any small rugged off-road utility vehicle. But really, the hype around this company is going to be not only this electric Transit, it's going to be pretty exciting for them, and the Ford Escape, obviously, being electric, it's going to be cool for them, and the Explorer, let's not forget that. But the real main thing is going to be the F-150 going electric and the Mach-E going electric, no doubt about it. Because the Mach-E is probably going to be their best-selling electric vehicle, if not the F-150 potentially. The F-150, obviously the #1 selling truck. It going electric. Again, the people that necessarily buy these trucks aren't really going to be the kind of people who are looking for electric, just 100% honest. But I think it'll harbor an entirely different audience for them, in my perspective. It's an entirely new market, because people who didn't want to get a truck because they're gas guzzling, stuff like that, they'll be interested in this electric F-150 because it'll give them the utility of a truck, but without the gas, without the harmful environmental destruction, as people who might talk like that would say. I'm not one of them, sorry. But if we're looking at valuation, right now, trading at a forward PE of under 7 with a price to sales of 0.18, price to expected growth of 0.48, price to book of 0.83. This company is trading at just ridiculously cheap valuations right now. Ridiculously cheap. And there's many reasons for it. I think certainly there's fears of this company will be invalidated in the future because of companies like Tesla, but I think people are definitely outweighing what electric vehicles are going to do. There's not one winner. If there's not one winner right now in gas vehicles, there's not one winner in electric vehicles. I don't know how that doesn't make sense. If internal combustion engine vehicles have 10 competitors that are all pretty well successful, how is Tesla going to be the only successful electric vehicle? They're not. They're just frankly not. And once Ford gets into the game, they'll do plenty fine, but we're talking 2 years out at this point, though, for Ford. So that's the thing. This is a long haul. So in the meantime, what do we like to see about it? Well, let's look real quick at this, revenue growth here. Overall, pretty stagnant revenue growth for the past 5 years. But obviously, we've had a rough net income line, and that's where this valuation's really gone down. So there's been a lot more spent on income tax. Nothing crazy, but again, this is something that was really an expected thing for them. So they were due to pay on this, but overall, we like the dividend of 8.62%, paying quarterly with a payout ratio of 57%. 5-year growth rate of 4.46, but they haven't had growth in a little bit. That's right, 15 cents per share, paying quarterly. I love the dividend on this thing, and I think it's going to be consistently 15 cents. I'm not afraid of any sort of dividend cut for this company. I think they'll be paying out this dividend for a good portion down the road. So that is why I'm a huge fan of Ford stock right now for dividends. So I really hope you enjoyed this different concept video for me, and if you did, let me know what you think. And if you want to see more, I will gladly make more every month. Thank you.